So my name is Rich Coppage. I don't know, they move me around, kind of the jack of all trades for Acquira, but I basically run what's called transaction advisory services, which is kind of post LOI to close. I'm also involved with the M&A team and doing some initial due diligence on transactions that we come across that we think may be a fit for uh, an AE or for an AE in certain markets. Also, if we're looking to buy a company, I will help on what we call our Empower side, which is our own, kind of principal investment um, side of the business from that standpoint. Also, pretty close with Chris Mooney, who runs the equity fund for the Acquire Capital Fund. So I spent a lot of time connecting with him on potential investment opportunities for the fund with AEs. So I have some insight into how he looks at these businesses and what he wants to see and what's investable and what's not. And along with that, I'm also helping to develop our network of outside investors for other businesses that may not be the right fit for the acquirer fund, but they may be in other industries and they may be investable as well. So I spend a lot of time working with those outside investors to find investments or to place investments with some of our AEs from that standpoint as well. Um, been with the firm for over 3.5 years now, which makes me, I think, full for as far as a full-time person goes. I think I'm the oldest person left on a full-time basis as far as outside of Hayden. So, then we've had people that have come in that come, they do certain things, they come and go, and maybe they're here part-time or what have you, and they have other things going. But I think I'm the oldest tenured full-time person at the firm at this point. So I got a lot of institutional knowledge as far as kind of how we've evolved over the last few years and where we're headed. So that's about it. And I'm the only one I think that has been to every single workshop we've ever had, which is kind of a crawl on my neck that I have to be at every one, but no, it's always a good time. It's always fun. So I would encourage you, if you get the opportunity to come to the workshop, to definitely take advantage of it. We have a good time, talk about deals, talk about deal structures, kind of what we like, how we look at them, how you probably should be looking at them as an individual acquirer, talk about partnering from an investment standpoint, different strategies, whether you want to do a roll-up strategy or a hold co strategy. And then, what it looks like on the exit side after operating, excuse me, after, woo, sorry, after operating the businesses for a few years, and understanding kind of what that looks like. So they're fun. And then, we feed you, we house you. You just have to get yourself there. And then we have a good time after meeting for those 2 days in the evenings. We'll have drinks, we'll have food, and just get to know each other. And then that last day, you guys get to actually go out and see an acquire, visit and acquire either own enterprise or acquire a partnered enterprise or one of the AEs who's bought the enterprise, and we've assisted at least on the integration side. So you guys just get to see what good looks like, as Hayden likes to say. So that's a little bit about me. I'm done. Oh, I also sit on the investment committee. So whenever you bring a deal to the investment committee, it's me and one other guy, or me and two other people. So you'll talk to me from that standpoint as well. All right, that's it. I'm done, Dante. All right, see you guys.
Thanks. Thanks for the intro, Rich.
Yeah.
Now I just have some questions, frequently asked questions, kind of related to LOIs. So some pre-LOI questions to start us off with is how long is the exclusivity period granted in the LOI, and what are the conditions for extending it?
Typically, I mean, it can be different depending on what's negotiated with the seller. Generally, we start off with at least, I like to start off with 90 days because I know they're going to try to chop that in half. Probably go to 45. We typically will end up in the kind of like that 60-day window. But kind of from the standpoint of what would extend it, here's the deal. When you get into a deal and you've expended some money, you've got 60 days exclusivity to start with. Let's just say on average, you get into a deal, you spend some money, you get down the path of doing a QOE. You've invested some time, some money. The seller at that point has delivered a number of documents to the QOE provider or to you or whoever. So they've become somewhat invested into the deal. So by the time you get to about that 60th day, I mean, really, exclusivity, it's still important in that you don't want the seller to go out and start marketing the deal, but at the same time, the seller doesn't want to restart the entire process anyway. So what ends up happening is if you need to extend it, a lot of sellers are amenable to that. But at the same time, it becomes less of an issue because the seller doesn't want to restart the whole process anyway. Because again, they probably invested some time and money as well. And by the time you hit that 60th day, you're probably in what I would consider confirmatory due diligence. The underwriter, your lender has started the process of fully committing to the loan. You've also drafted or started the drafting of the purchase agreement. So it's in their best interest to continue with the relationship anyway, just because their lawyer is working and they're probably paying that person as well on their side to kind of get to the finish line. So I don't know that it's necessarily important to extend it at that point, but usually if there is an issue, the sellers are amenable to it just because, again, they don't want to restart the entire process from start to finish because that's a longer period of time that they have to now go and wait for, go through that entire process again and wait for their check to go on their vacation. And then the broker on top of that, the broker obviously doesn't want to restart it because now their commission is out even a longer period of time. So they'll do their best to kind of work with the seller as well to actually make sure that the transaction happens. And even if there's a non-exclusivity there and the broker does manage to go out and talk to someone, the broker, again, it's in that broker's interest to stay on the path that they're already on. Otherwise, again, they're not getting paid for another 90 to 180 days or what have you. So yeah, that's kind of how I would answer that.
A lot of the times brokers also have a limited time frame, right? That they even have these deals for, right? So like when they typically, from what I've learned at least, like when these people retain a deal with a broker, they have like a year, 18 months or some period of time. So kind of like what Rich said, they're also, they have their own level, like their own period of exclusivity that they're also on a clock that if they don't perform, they might take it somewhere else, right? So that's a whole nother angle.
Yeah, exactly. And that's why it's in their best interest to actually work with you to get the deal closed.
Yeah, thank you, James. I didn't know that. So next up is what information and access to the business will be provided during the due diligence process?
Depends on what level you're at. So pre-LOI, you're going to get the basic information. You're going to get from a broker, you'll get the SIM. You'll get some summarized financial information. Usually it's 2 to 3 years worth. Sometimes within the SIM, they'll provide you, an extract of the tax returns. Sometimes the broker will actually provide you with the actual tax returns as part of the pre-LOI due diligence. But that's about all you're going to get. I mean, you may get some sort of summarized organizational chart. It won't be overly detailed, and you may not get any. I've seen a lot of brokers, they just don't provide that. You'll get kind of an overview of the business and where they've been, a narrative that the broker's written. So within the SIM package, pretty much that's the only information you're going to get. And they'll usually sometimes send you maybe 3 years of like QuickBooks printed statements or something like that. I don't necessarily trust that information. But at the same time, that's the information you're going to use to formulate an initial offer. And obviously, when you formulate that initial offer, everything's subject to verification. We'll pay you a multiple of X on your SDE, which comes out to this price, subject to verification. You're always putting subject tos in that initial offer because it's going to change because that information, once you kind of get through the QOE process, it's usually different. The SDE will come out different, but you protected yourself from that standpoint. Now, when you get to the LOI stage of due diligence, you're expected to get all of that information. So that's going to be financial information, obviously 3 to 5 years worth. of annual information. You should get at least 18 months worth of monthly financials, if you can get them. And when I say that, it's just not 18 months of P&L, 12 to 18 months of P&Ls. I want 12 to 18 months of balance sheets as well. When I'm looking at a deal, I want to see exactly how the cash flows through the business, and you can't really necessarily tell that just from the P&Ls. You need the balance sheets to kind of match that up, to see, a lot of times I'll use the balance sheets to detect if there's some fraudulent accounting going on. And I won't get into the specifics on how I can tell, but just from my audit background, it's easy to tell if people are fudging numbers. But you want to get all that information. You're going to get, during the due diligence process, you're going to get information about the employees, payroll registers. You're going to get information about sales and marketing activities. And when I say that, I mean understanding what their sales process is. It will give you a detailed due diligence listing to actually go through. And I think some of you guys have seen that in training. But you want to get you're going to get all of that information about the entity. You're going to get information about, if there's any lawsuits within the business. That part of the due diligence process is where it's a lot of data collection. It's a lot of narrative collection. It's a lot of understanding and synthesizing all that information along with the QOE you're going to get, which kind of verifies the financial piece of it. But again, even when I tell these to AEs when we're looking at QOEs all the time, yes, you get a QOE back. And the first thing everyone wants to do is go to the SDE number to see what that number looks like, to see if it's verified. And that is probably the first thing you want to do. But everybody tends to dismiss everything else that's within a QOE, okay? QOE is just a starting point for your analysis. It gives you some comfort level that the numbers are relatively representative of what they should be. It's not an audit, so whatever you're seeing there is still based on what they're giving the QOE provider, whereas an audit is more of a verified audit, and it's a little bit different than what a QOE is. It's a verified numbers through substantive testing and all that kind of stuff. But then once you get that QOE, you still have to go through every single piece of that QOE and determine what it means, what the information means. So yeah, great, the sales and marketing are up, they're trending up. So what? That doesn't mean anything. Okay, why? The most powerful question you can ask when you're looking at your QOE, why are the numbers up? Is there a structural change in the business? Did you implement a sales and marketing strategy that's meaningful, that's going to be able to be carried forward? Okay, so the idea for the QOE is to understand what your sustainable earnings number is, so that you can then go back and either reprice the business if you need to, or restructure the terms of the offer. But you also understand, if they told you that they had 30 employees, and then all of a sudden you're looking at the organizational chart and there's like listed as 15 employees. Okay, what's this? Why do I only have 15 employees listed when you told me 30? What happened? Were you having a lot of employee turnover at this point? Why is that? Is there a bad culture problem with the business? All that affects your valuation as well. Tell me about, why are operating expenses growing as a percentage of overall revenue? Did you just take on a bunch of new leases and now you can't afford to pay them because you're not having enough turnover or sales in the business? But you need to really take your thinking to the next level when you get to the QOE. Don't just take the QOE, accept it just because the SDE number is there, and then assume that everything's great and gravy, because I've seen it blow up where AEs end up buying a business and I'm like, I go back to it and I'm like, look, this is a question you should have asked during that process. You got your QOE and decided you wanted to run with it because you were so desperate to buy a business. Don't ever put yourself in that position. So in answer to your question, your pre-LOI due diligence is going to be very high level. You're not going to get a whole lot. Don't expect to talk to employees before you get to the purchase agreement draft. And then your post LOI due diligence you should be able to get everything that you ask for. And if you're going to be in a situation where some things are more important than others, and if they don't have that information available, which you tend to see with small businesses, they're not really sophisticated from an accounting standpoint. But if they don't have that information available, they don't track it, you got to make a determination of whether there's enough risk in not having that information and moving forward, or if you could kind of skip over that and move forward for the time being. And then there's ways to protect yourself in the purchase agreement from that standpoint. So sorry for being long-winded, but that's kind of a hot button issue with me, Dante.
No worries. Yeah, go ahead, Daniel.
Yeah, so my question is pre-LOI, like during the negotiation of the LOI structure and so forth. I'm wondering, like, what's ethical, unethical in terms of actually talking to the seller personally, like having conversations with them? How is that? And what would you do personally? Like, I would like to build a relationship beforehand, possibly, but then I'm kind of thinking maybe it's not allowed, right? There's this like, kind of like, I guess, tug and war going on, right, with the LOI and so forth. So I'm just wondering, like, what would you recommend personally, and like, what's acceptable? Like, I could just pick up the phone and talk to the seller personally, and just like, hey, what's going on? How you doing? Try to build some rapport for post LOI. What's your thoughts on that?
I would say always let the broker control it pre-LOI. The reason being is because you don't want the broker to sabotage the deal. If the broker has kind of communicated something to the seller, whether it's accurate or not, they're on the hook to the seller for that, and you don't want to make your broker look like an idiot until it's necessary to make your broker look like an idiot. And that won't usually happen until the LOI sign and you actually get to start working directly with the seller. So my recommendation is don't go around the broker's back initially. Let the broker sometimes what you'll have is a broker who's in it for the commission, and they're pretty lazy and they just want to make the connection, and they'll like introduce you to the seller right off the bat and basically say, yeah, it's okay for you guys to talk together, just because they just want to kind of move on and do something else while the deal's happening, and they'll step in as necessary. I'd say the majority of brokers, though, they want the seller to feel like they're earning their money. So I'd say let them control that from the get-go, and that's always been my rule of thumb when I'm actually looking at my own deals, is let the broker control it early, unless the seller reaches out to you directly. Then maybe you can have that conversation, but at that point, the broker's probably passed your information to the seller, and it's probably okay. But then once you get into the LOI phase of it, you're going to be working directly with the seller anyway. And if the broker seems like they're being an obstructionist, at that point, yeah, I would want to work with the seller directly. We're having an issue with one of those, with a transaction like that we're managing right now for one of the AEs, where the broker just is scared of the seller for the most part. And they don't want to present some options that we've talked about for actually closing on the deal, because there's a working capital issue that we want to solve for. And so we're going right directly to the seller. And the seller is a matter-of-fact person, but I think it scares the broker. So sometimes you have to gauge those relationships. But yeah, let the broker lead at first, at least until you get a signed LOI, and then you can kind of make a determination whether it should be a direct call with the seller for issues.
Okay, because I am working with Acquira in the Accelerator Plus, and it's like I know the seller has their own broker and so forth. So I was just kind of wondering what's Acquira's stance on that, right? Because I know they had an intro call and so forth, right? But their broker was there and so forth. So I'm guessing they just kind of want to just stay back till actual signed LOI.
Yeah, it's kind of like, on the M&A team, they work through the broker, and we have our own internal broker, Alejandra. She came from the business broker side. So she knows exactly how to have those conversations with brokers, and she knows the kind of the pain points to on which to push. So I would also like to keep the broker involved, because what's going to happen is you're going to be in a situation where you're going to need some pushback, and you don't want to be the bad guy at that point. So let the broker be the bad guy. Also, in your banking relationships, a lot of times when I'm looking at a deal and I'm just like, well, wait a minute, this thing's overpriced and there's no way I can get this thing financed, then what I will end up doing is, if I'm in a discussion, if I'm with the seller, I'm like, look, hey, I really want to pay you this for the business, but my banker's like, there's just no way that they can finance that. And I make the banker the bad guy from that standpoint. Okay. So you always want to be kind of the face that they want to talk to. They want to have a positive experience with you, but you want to use the broker. You want to lean on the broker. You want to lean on the bankers. You want to lean on your lawyers. You want to lean on even us as your advisor to be the bad guy and deliver the bad news from that standpoint, because you don't want to destroy the rapport that you've built with the seller once you've got that rapport built.
Thanks, Rich.
Yep.
Go ahead, Thomas.
Hey, Rich.
Hey, Thomas.
The question is, coming from finance background, for better or worse, I always want to have as much information as possible to move forward with anything. So, I took the Acquira pre-LOI list and I sent it to a seller, and they never answered. And then a few weeks later, I was able to figure out through the broker that they don't know what to do with this many questions. And I cut back those questions to a very smaller chunk of questions.
Yeah.
It again, no answer, and seller doesn't want to answer any of the questions at all. So we netted out in meeting in person, so I'll be able to ask these questions, or at least some of these questions. But that was the story behind my actual question: is what is the minimum information requirement that gives me enough knowledge or enough confidence to even entertain an LOI?
Yeah. So, and this is where I've kind of split a little bit on the training, and I think internally we kind of, at least on our own M&A process, when we're sourcing opportunities, I think we're getting more comfortable with the way I would handle it. My thoughts on handling it, because I know a lot of times you get this list and you want to send it over. Hey, can you get these questions answered so I can put in an offer? But really, you don't need a whole lot of information to put that initial offer in. And and you have a finance background. I come from finance as well. And when you're looking in the world of what I would say larger transactions that I used to do as a banker, the idea was you had access to a lot of information because those companies actually had it prepared ahead of time. And so they had a package put together. So you could fold, those questions. You could basically take that package, go through those questions, and basically have the answers that you needed. With smaller businesses, owners they're not used to doing a lot of this work. The brokers, even on that side, most of them are real estate brokers. They don't actually understand kind of business acquisition. And so all of a sudden you send them a bunch of questions, they become paralyzed. They're like, I don't want to deal with this. I thought it would be easier. So I would say the minimum amount, and this is, I'm going to say it this way. This is my opinion, and this is how I'd approach it when I'm looking at a business and I want to put an offer in. It's not necessarily appropriate for everyone, because I think a lot depends on how comfortable you are putting in offers with incomplete information. So generally, when I'm looking at a business and I want to put an offer out, I'm usually focused just on some high-level quantitative metrics. And I'll tell you, I just need to see 3 years worth of P&Ls, and whatever their numbers are. I'm just going to accept those numbers as representative, knowing that more than likely they're probably pumped up from the broker's perspective. Just give me 3 years of P&Ls. Give me at least 2. If I can get 2 years of balance sheets, that's fine. If I don't get any balance sheets at that point, I'm okay with it. But I'm gonna, I don't know what assets are in the business, so I'm a little, I may downgrade my offer just because I don't know if they have any significant assets in the business. But at least give me that. Give me an org chart, and give me a summary of what the business is and what products and services they sell in the marketplace. If I have that, I can generally get to a preliminary offer. And really, that's all you need, because the thing I'm going to look at is I'm going to look at their bottom line profit. If they've got their cash flow there, we'll figure it out what that looks like. And then I'm basically going to form an offer around, do they have a strong management team? I don't know if any of those people are leaving, but do they have a management infrastructure in place? What industry are they in? Is it project based? Is it or is it recurring revenue? So I'm thinking about these things at a high level to formulate kind of an initial offer. And that's really all you need, because that preliminary offer is going to be so vague in terms of what the ultimate price is going to be. I may not even discuss structure of the deal. I may just discuss just the ultimate price. based on this multiple subject to verification. And that's all you really need to go. Once you kind of get to see once you see if you're in the ballpark, if you're basically on the field or they counter, what you can then do at that point in time is start asking those relevant questions that you need to get answered, at least to maybe reformulate your offer. Hey, I mean, how long has this business been on the market? What is the seller doing on a daily basis? Because once you've got an offer out there, and even if they counter, they know they're considering selling. They think you're a serious offer. If they don't counter at all, it's not a serious offer. They're probably not going to respond to you. But once they counter, they're in the game. They're in, and they're going to be willing to provide you just a little bit more information for you to accept the counter or come back with another counter offer. And I would say the information you should probably collect, if you guys go through that IC deck, just collect that high level information, as much of that as you can, and you should be good to go. I wouldn't worry about trying to get monthly financials, trying to talk about key employees at that point. They'll either divulge them or not. I wouldn't worry about trying to get detail on margins on every single line or service of business that they're doing. Don't worry about all that. You just want to get enough information so that you have a summary. You've got a good idea or can encapsulate what the business is about, what markets they're in, how much they're selling in those markets. I don't even necessarily worry about the major competition at that point, because you can do your own research on that. But do they have an employee base, or is it subcontractors? And generally, what are what they see as the high level risks in the business? I mean, if you have all that stuff, yeah, you should be good to go.
I see. High level risks, like how I've tried to ask those from.
Don't ask that question though. You have to determine that. So, I mean, you can ask that question once you get into due diligence, because then they'll be willing to talk to you about some of the challenges that they've had. But until you get to LOI, they're not going to tell you anything until they get an offer in hand that they think is solid. When I was thinking about the risks, really, and I probably should have said you asked them about that, you have to think through, okay, if this is let's just say a plumbing business, and they have, let's just say they have an organization chart that has they want to grow the business, but they have like 3 plumbers on staff and they're trying to market to this larger market, then what are the risks around that? I mean, you've got to be able to, okay, well, number one, they only have 3 plumbers, so I'm going to have to hire more plumbers to grow this thing. Now, how many trucks do they have? Each plumber is probably going to have his own truck. Are they if they want to go, if I have to subcontract out for plumbers, how many plumbers are actually in the market that'll be willing to, that have to subcontract with, and how much control am I going to have? It's just thinking through those business issues. Once you understand what the industry that they're in, you'll come up with your own risks and how to kind of mitigate those risks. But then they'll confirm that once you actually get into due diligence from that standpoint. So I wouldn't spend time asking them about risks. They're going to say, oh no, this is the greatest business in the world. We have no risk. We never market. Everything's referral. We've got this great reputation in the marketplace. Even in recessions, our business just, they're going to give you the pie in the sky answers. Fine. But I wouldn't even worry about asking them up front. Just get 3 years worth of financials. Try to get an org chart if you can, to see what the organization looks like, to see if it supports the numbers that they're saying. And then from there, I mean, if they've got an asset listing, great. If they don't, great. But really, with that, just even with those 2 pieces of information and understanding what industry they're in, you should be able to be good enough to form an offer and go from there.
Okay. And what about add backs? Like there is this always this awesome line of owner benefits.
Yeah.
It can be like 2/3 of the SDE.
Yeah. So from an add back perspective, I always just take the add backs that they give as true and representative, and then I may adjust. You got to think about, from your perspective, if I'm buying this business, am I going to have to hire a general manager, or am I going to be the general manager? If you're going to hire a general manager, then you have to adjust the owner, the add backs to reflect the fact that you're going to have to hire someone. I usually use anywhere from $100,000 to $150,000 for a general manager role, depending on the market or what have you. So you would adjust if I got like $250,000 in add back for for salary for the owner, then I would basically knock off, 100,000 of that or 150,000 of that to get to what the true add back is for that. That is probably the major adjustment that you want to make to the add backs to start with before you put an offer in. But that's your knowledge. You know exactly kind of where your background is. If you're going to step in as a GM,
Well,
if you step in as if you're going to step in as a GM, then their entire amount that they're adding back is probably legitimate, because you can determine what you're going to pay yourself, especially if you're not going to have another investor in with you.
Yeah, but either way, then it's going to be my time. So then,
yeah, it's going to be your time, but you can determine what you're going to pay yourself, whether you're going to pay yourself through just straight dividends or whether you're going to pay yourself a salary, and you can adjust accordingly. So their entire add back might be legitimate from that standpoint. But the idea is that if you're not, and you're going to have to hire someone and pay them a salary, then for sure you want to adjust that, because SDE means seller discretionary earnings, meaning after you paid all the expenses for the business, you paid your staff, you paid, your really, it's your lender, which people don't really consider. You made the payments on that. What is the bottom line cash flow that I can do anything with that I want? Can I pay myself that money? Can I go invest in another business? Can I take my family on vacation? That's really what SDE is supposed to represent. So there's some subjective nature to that number as you're trying to figure it out. But a lot of times, if you just make an adjustment, I just assume you're going to hire a GM, okay, so that you get the most conservative estimate, and then make your adjustment to SDE, and then adjust or do your valuation based on that. Sometimes it's just, I'll take the number that they represent, and I just, okay, that's the right number. If I'm looking to make a quick offer, that's the right number. I'm going to base my valuation on this. But remember, in your preliminary offer anyway, it says subject to SDE verification. So when you ultimately get through the QOE process and you make your own adjustments, that's when you can go back to the seller and say, look, by my calculations, the true SDE, carry forward SDE for this business is Y, even though you said X. And so the way we solve for this is either we need to adjust the sales price of the business, or we need to adjust the terms and structure of the offer. So I would say, don't get so caught up on what the actual SDE number is, because you can always make adjustments, and you can use that QOE report and your lender as the hammer on that side to say, look, this is what they've come back with as what the SDE number looks like. So, this is what the loan can support. This is what if it's an equity investor with you, this is what my equity investor can support. Let's talk about revaluing the business or changing the terms of the offer. So don't get too caught up though in the minutia of the SDE number up initially, the add backs.
you think they're not going to walk away if I slash their price by 20%, 30%?
Well, it depends. I mean, because they're going to come across as an investor, they're going to come across the same issue with every single buyer down the road if it's not a legitimate number. If it's a puffed up number, any smart buyer is going to see that and make the same adjustments. And that's all you need to communicate. Look, the general market for this is going to do the same thing that I'm doing for it. Just explain to them how you got to your numbers. And a lot of times sellers are pretty reasonable with it.
Oh, are they? Okay.
Yeah.
So
as long as you can show it to them, and especially if you have a lender that's saying this is what the true SDE is, because they know pretty much every lender is going to be around the same ballpark, so they know they're not going to be able to puff it up. Ultimately, they could puff it up in the beginning, but in the end, most lenders are going to be around the same valuation, just because of the way they underwrite these things.
Oh, okay, that's understandable. I was just worried that we go down this road, I spend the money on QE, and I waste my time, and they are like, okay, then if you give me 1 cent less than what I want, I'll walk.
No, it's not a 1 cent. And again, I'm willing to pay I have a philosophy. I'm willing to pay any seller the price that they want. You tell me the price, I'm going to tell you the terms. So if you're asking for $8 million for your business and I value it at $5 million, I mean, I've pulled this before. I was like, yeah, I'll pay you $8 million for that thing. And here's what the structure is going to look like. You might not get that extra $3 million for the next 30 years, but you may get it if the business performs. So I mean, there's a way to get everyone. There's a way to get sellers to the table, because all they picture in their mind is total price, but they don't understand that sometimes the terms and the structure of the deal are actually more important than the absolute price that they're getting. And a lot of sellers, they just hear it, that end price, and then they don't realize it. I mean, when I bought my manufacturing company, they were like, look, we think this thing is worth 15 million. And I was like, my partner and I looked at it and we're like, this thing's not probably worth more than 8 million. So what we did was we structured a $12 million. We came to basically the middle. We were like, look, we'll pay you $12 million for this thing. But the way we had the seller terms laid out, we were thinking we'll never have to pay this additional 4 million, because the targets that the business would have to hit were like astronomical growth. And we didn't see how that was going to happen. But the seller, he heard 12 million. He's like, look, that sounds like a great deal to me. Let's do it. Now he's gotten the benefit of it. Ultimately, we've ended up paying him thus far probably close to 10 million with his earnout in place. But still, that final 2 million, really sketchy whether we're going to get to that within the time frame that we laid out for them. So what the bottom line is, what I'm saying is, structure can get you over the top if you feel like a seller's going to walk away. You just have to structure the right deal that's protective of what you're going to ultimately end up paying. You don't want to overpay no matter what, but you can structure a deal that makes sense. So sellers tend to be willing to kind of work with you.
Okay, understood. And one more quick question. So when I see the last 3-year SDs, miraculously, they skyrocket.
Of course.
For the last year. And of course, valuation is based on that one last year, not on the past 2 years.
Let me back up right there. Never base your, and I tell people all this time, no matter what you're reading, never base your valuation on just the trailing 12-month number or the last year, because what you're going to find is a lot of businesses get puffed up for that last year, and they could have had their best year ever, and they didn't. Sellers are trying to sell their business based off of that best year. I'm going to look at at least the last 3 years, and I'm going to see what the revenue fluctuation looks like. Not necessarily SDE bottom line numbers, because the SDE they can kind of play with, but I'm going to look at kind of the fluctuation of the actual sales in the business. And if that thing's going up and down like that, okay, I'm just basically going to take, and it depends on the type of business. If it's a service business and you see this, I'm going to probably just average them out, and that's what I'm going to base my valuation on. If you see this on a project-related business where most of their business is coming through one-time projects, usually what I will do is to start my bid, I will take the worst of those 3 years, and that's what I'm going to make my initial offer on. Because one thing with project-related businesses, they're lumpy. And you could have 1 year, they could have one big project and then not have another big project like that for the next 5 years. And so if it happens to come in that third year and you overpay for the business, you're not going to be able to service your debt. You're not going to be able to pull cash flow out to pay yourself. So you're going to find yourself in a whole world of hurt. So never, in my opinion, and I've had some arguments internally with people about this, is never just pay off of that single year. That's not a smart strategy. Never buy a business off of 1 year's worth.
Unless the last year is the lowest year. Then
unless the last year's the lowest, yes.
That's my deal. So
Yep.
I was like, yep, no, we're not looking at this last year. Nope. This year only.
Yeah. So. Great point, James. Yeah, that's the one exception I would make. Yeah.
Got it. Thank you. Appreciate it.
So I did have my hand up, so I'll just continue. So a few points from previous people. Tomas, so pre-LOI questions, when I was doing that, so I'm under LOI now, but when I was going through I would always do that over the phone, right? So I tried and some sellers are gonna be different, but like those questions are a lot of them are just very easy conversational questions, right? where you can just weave it in, to a 30-minute, and it's not one call either, right? It's not like you need to get literally everything at once, right? You can kind of just, I don't know, hit him with 10 in a 30-minute phone call. And then, hey, if you really like his answers, then, you want to continue. Well, then you'd schedule another call in a week or something, and ask for some documents in the interim or something. If you had some rapport on that call.
Yeah, I would agree with you, James, on that. A conversation is better, but the only thing that you need to consider, a lot of times these pre-LOIs or the pre-offers, you're not going to be able to speak directly to the seller. And so then it depends on the knowledge that the broker has. So sometimes brokers are like really well versed on the business and they can answer a lot of those questions. And that's where that phone call actually is perfect. A lot of times brokers, they don't have any answers. They've just kind of put together some sim to send out. And it's just like, no, put in an offer right now. And then we can have that discussion. We can have that talk. So
I've only seen those. I've never seen a broker who has any idea about the business, of any aspects of the business.
Yeah.
I've seen it. I've run it. I mean, it's probably, I would say 10%, right?
Yeah.
It's like 10% actually are on their game. Not, maybe 70% are mediocre, and then maybe less than that. And I would say 50% are just real estate agents who are like, hey, there's a lot of money in businesses. I've sold some real estate. Might as well sell some businesses too. Same thing, right? So, and I agree, siding with the seller, right? So in my deal specifically, I'm doing that all the time. Like sitting on his side of the table and be like, listen, I know this is a pain in the ass. The bank wants it, right?
Yeah.
Like the bank really needs this stuff, right? Like, they've got the money, right? Like the bank's the one with the money. We got to make them happy, right? So then you're not the annoying one who's trying to feed your own,
yes, Paul,
craziness. And so then I had a question for you, Rich, regarding my deal. So I'm doing the Q of E. The numbers are going to be off, right? And so as soon as, I kind of paid for the Q of E and we're getting into it. So my deal is specifically a carve out, right? So we're buying like a line of business under a corporation, whereas one was losing money conveniently. This business is making money. Once we're under Q of E, we find out, okay, they're not like separating all the expenses, right? Like they're kind of commingling. They did like a percent. So when they presented me, like for instance, with the P&Ls and everything else, he presented me with, okay, this is how much we're spending on software, this is how much we're spending on utility, blah, 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 right? So like even the software, he kind of had everything into a bucket and then allocated a percentage, right?
Yeah.
So and I'm like, well, a percentage, if I would have known that before the Q of E,
I'm not gonna buy a percentage of the software.
Yeah, so it's like, great. So you have 3 businesses under the software. Well, if I have one business, it's the same price, right? It's like if you have more, sure, maybe it dilutes your cost basis, right? But point being is that the earnings are going to come down, right? Just based on this allocation that he had, immediately the earnings are going to be lower, right? Once we figure out how we're going to, solve this allocation problem. So I'm like holding off on legal, right? Like I'm holding off on everything, right? So until this Q of E is clear at least, right? So I guess my question there is, I already have a very creative deal, right? So like my deal is like 30% seller financing. I've got a full standby note. I've got a contingent note. I've got, real estate involved in the deal. So it's already very creative, but this seller is like all about his cash at close, right? So like he's just his number, he doesn't even think the seller note money is real, right? Maybe for good reason, I don't know, so it's like he thinks that, the only money he can count on is his cash at close. But if I have to retrade this deal, that's pretty much where a large piece of this has got to come from, is the cash at close, right? And not these other notes that are kind of protecting the future of the deal, because the business kind of had a huge COVID bump, right? So it's like they had, they did double during COVID, right? Or maybe even triple almost during COVID, right? But then pre-COVID is kind of where we're at now, right? But so I have the contingent note basically to make sure we're not going to keep trending downwards, right? And to kind of protect against that. What is the best? So like, as you mentioned, your price, my terms, and that's exactly how I attacked this deal, right? It was his price. I'm like, listen, I'll get you your price. This is how it's got to be. This is the only way a bank is going to finance it, right? It's kind of how I was like, like I can get you this number, but these are the terms, and it includes all the inventory, and it includes some cash at close, and it's like a 3.5x multiple. I don't know how, depending on where this comes in, I don't know if I can be any more creative, or if I should just be. I mean, I'm already kind of preparing myself to just walk, right? Like I just might have to, just because I can foresee how this seller is, just a hard-headed, and he's got his number in his head, and he's got a lot of debt too. You know what I mean? I could see it from his perspective that he's paying off a lot, and he's really not going to be walking away with a huge number, even though it's like a $9.5 million transaction, right? But it's like just under 7 million cash at close, including the real estate. So I guess in your opinion, because like this is something that I don't even know if he knows, right? So he's got again, everything's all together, right? It's one company. He literally has everything running into the same bank account, right? It's all, and then it just goes from there. He doesn't handle the books. He's got a third-party firm who is extremely slow, right? Like we're a month in, and we don't even have all the documents that we need into the QOV. And I guess, I don't think that he even understands his own financial situation, right? And then here we are, like immediately, again, right now, I know that it's going to be lower. So I don't know if I should have that conversation with him now, like should I be like, listen, we know this is going to be lower, we just don't know how much lower.
So
right?
let me ask you this. So is your QOE provider carving out the specific assets related to the acquisition?
Yes.
And coming up with an earnings number for that piece of the business? Because it doesn't sound like they got the business prepared to actually sell that, to carve out that piece. It doesn't sound like it's prepared for that. So I'd want to, before you have that conversation, just wait for the QOE to come back, number one, to see what it looks like, and whether the QOE provider was even able to carve out reasonably. Because again, I mean, you can't really carve out unless there's he's doing an allocation for like software and all and what have you, but that part of the business probably just doesn't own its own software, like you said. That part of the business is, I mean, are they sharing facilities with the current part of the business? Are they sharing employees? Which employees are going? Which employees are going with the carve out? Which ones are staying? I mean, it's hard to get to a conclusion on that without you having some detailed understanding of what it is you're buying. And from that standpoint, when you're looking, especially with a carve out of a smaller business, I would actually force them to list out exactly all the assets and people that are coming with the business. Try to understand exactly what that business earned, and then base your valuation around that. The value of those assets, and obviously those people kind of can add to whatever or take away from the value of the business, depending on what they did within the business. But you got to get to some sort of detailed and agreed upon listing for what that looks like. And it can't, and I'm saying they can't just allocate software as an asset. No, it's not from that instance, it's not an asset that you're buying, because that software, like you said, you're going to have to buy new software, because you're probably not going to be able to take that piece of the software related to that carve out for what they were doing, and then all of a sudden extract all the other business from that. I mean, it's just, you're going to have your own software.
So for example, so they have, it's an e-commerce business, right? So it's not a service business, it's an e-commerce business, and they have like warehouse software, right? So let's say that's 20 grand a month, right? So then they had allocated like a percentage. So 60% is for the brand that we're acquiring, and then 40% because the other brand's actually smaller. So but if I didn't, if it's going to cost me 20 grand either way, right?
Is that
So it's
software
like,
provided? Is that software provided by a third party, or is that?
yeah, it's not his. Yeah. So they're
Oh,
paying.
that's
Yeah.
that's irrelevant.
Yeah.
I mean, that's just an expense then from that standpoint.
Right. So it might be 2 grand less or something if he didn't
Yeah.
have the extra SKUs from the other thing, or like utilities, right? So we're buying the warehouse. He's got the utilities split up, and it's like we're paying the electric bill, and the largest piece is the air conditioning, right, and the electricity. And guess what? That bill isn't changing no matter how many people are in that bill.
With the carve out, are you going to be responsible for the warehouse facility?
Yes. Yes.
Okay, so then all those costs related to the warehouse go with you. So as your QOE provider is going through this process, they should have an understanding exactly of what, like I said, of what it is you're getting, because you're going to have to pay those expenses for the warehouse. So that should go in your calculation of what your earnings are. You're going to have to buy your own software. That should be a calculation of what the true earnings are for this business. Obviously, whatever part of the business that you're buying that has the revenue attached to it, that should be fairly easy to figure out from that standpoint. And then you're going to have to figure out exactly, okay, I'm taking this employee, and this employee. What are they currently making? And you're going to use that as a proxy for what you're going to have to pay for them. And so in essence, you're creating almost like a pro forma P&L for those costs, and then on top of that, whatever assets you're getting, you're you're paying for those as well as part of the business. But you have to get to that. Your QOE provider has to be able to provide you that pro forma of what those actual items are that you're getting in the business. It can't be just some blind allocation. Okay, this person's working halfway on this business, and they're working half, so you get 50% of the expense, and that's what that's part of your calculation. No, because that person, you can't split that person in half, and half of that person goes with you, and the other half of their body goes with the other business. I mean, that's just that's ludicrous.
So the bank, they're the ones that they're like, hey, we got to have a QOV on the full P&L, right? Yeah. So they did a QOV previously. So there was a previous buyer to this, and they were going to sell for like almost 3 times the price, right? And the business kind of continued to trend downwards before we're kind of going back sideways and up now, right? But that deal fell through. They did a QOV on the buy side, but that previous buyer is the one that, because this other brand that he's keeping, that one was doing way more as well, right? So that one kind of fell off. And so anyways, essentially, yes, we're verifying both sides, right? So that's a requirement from the bank. They're like, we have to, we're not just verifying this over here. We also have to verify these expenses over here and make sure that none of those apply to over here, right? So I guess my question is though, and maybe I just wait, maybe I just eat it, right? Because I'm 10 grand in, for example, I've got another 10 grand to go, right? And I see the writing on the wall, and I know that this conversation is going to have to be had. So the question, is like, do I at least say, hey, this is going to change, and prime the pump, if it's gonna fall apart, does it fall apart now, or do I just wait until we have solid numbers and have to get him more invested?
You're already in the QOE process. Just let it finish.
Okay, that's what I'm thinking.
Before you even worry
Before
about it. You just want to see what.
Don't insert doubt and be like, oh well, what do we need? And then it seems wishy-washy, and then he might just walk because of that, anyways. And then
the reason I say that, wait, because then you can show them on paper too exactly what you're looking at, instead of having some ephemeral discussion and there it goes back and
that's
forth.
what I'm thinking. Right.
You deliver them the document. Look, this is what it came back. Let's work from this. That's more solid for them to work from and for them to understand, to see it in writing versus you telling them. So I'd say just wait on it.
That's what. Okay. Yep. So I appreciate it. That was really that was my question. If I should wait or if I should.
Kelly's like laughing because I told her that's what we're waiting on her deal too. Jeremy, you got a question?
More I guess it was my story. So we've actually closed the deal, and I think everything we've been through follows along. We focus strictly on the IC meeting details pre-LOI. and once we put our offer in, we had exclusivity, and we knew QB was taking a lot longer. So we had a call with the seller while we're still in QB and said, look, the bank needs 60 days.
Yeah.
So the longer QB takes, just heads up. So they're aware of that. And the QB I think it took us almost 3 months.
Yeah, I remember that because I was working with
seller he's not an accountant, right?
Yeah.
And then half the time the accountant's on vacation, so I have no idea like what he
I
was
remember
paying.
that. I was like, what's taking so long?
But it was easy to get it extended because we told them, hey, the bank needs 60 days once it's done.
Yeah.
The other thing is it's a lot easier to change your price with the support, like Rich said. So yeah, you need the cost, but end of the day is so for us, again, the financials are funky. SIM was funky. It was all old. Everything was like 2021. We're buying this thing in 2023. So we split our QOB to be focused on proof of cash. Like, let's have we had Ripple do it, but we know, let's confirm the money they said they made actually hit the bank.
Mm-hmm.
That gave us, that was step one of QOB. So we're like, okay, that actually happened. So, all right, maybe the valuation's there. Then we did the QOB. And then towards the end, the seller was just getting flustered. He's like, he doesn't understand half these words. We're having these conversations. So we present the fact of, hey, look, now, how about, since the QB is now done and we're going to give this to the bank, let's you and me just talk operations. We'll have your accountant talk to our accountant. We'll have, find your legal guy, talk to our legal guy, and they'll loop in the bank. And the last 60 days, like, it was just all them on the side figuring out the details. Like, we'd be involved with our side, but he didn't care. He just like, all right, transaction's gonna happen. And we told the legal team, hey, look, you need to have a full standby for 20%. And they're like, fine. So when they went back to his lawyer, it was like the bank required it, and the seller just signed it. He didn't care because he was just, this is all too much garble for him. So that's one thing to help alleviate the seller once you guys get there. But on the Q of E timing, it does take forever, and it's because they're just not knowledgeable. But I would say once you do the exclusivity, have a quick call in the middle, like within the first week, and just give them a rough idea of how it works. Like post QB, the package goes to the bank. In the meantime, we'll talk to the bank as well, but that's going to take 45 days no matter what. So therefore, the QB takes longer. You got to apply that exclusivity extension. You push it to the bank again. Just blame the bank's the key, right? But you've already mentioned it. So in their mind, they're like, okay, 45 days from this point, 45 days from this point. Yeah. And it helped us. And I don't know if that'll help everyone. But yeah, it's hard to preempt the seller, like, hey, I might be changing the number. When it's easier to be like, hey, look, I have to change the number, and here's all the proof. Yeah. But that was just our experience.
Yeah. What is it with accountants and vacation? Like, what is that? Because that has happened. Just trying to get updated P&L. Like, oh, sorry, my accountant's on vacation. Twice. He's got two separate, like, he's got a CPA firm, and then he's got like his book, and I'm just like.
So let me answer that question. So first of all, as a former CPA, we work very hard. So, we need our vacation.
1 month a year.
When you're staring at spreadsheets. Yeah, when you're staring at spreadsheets 11 months of the year, you need about a month off. So that's number one here nor there. The second thing from that standpoint is a lot of times they use the accountant as an excuse. So if the accountant's not really on vacation, they're just not.
Like us with the bank. It's like us with the bank. At the bank. Oh, we're
either the accountant's not organized or they're not organized. It's one of the two, and they're scrambling to get all the information put together. So
and the good way to think about it is like they weren't, they opened this business, right? They run it. They're putting everything they can through it, right? Yeah. They go buy a car, and now they're trying to sell it. So it's like trying to split it out. Now you're trying to go back years of, your years of your credit card statements and saying what was actually beneficial to my company versus what was for fun. Like it's time consuming, right? So that's where you got to kind of be like, let's try to alleviate some of these pinpoints. I would just connect them and just let them figure it out.
Yeah.
But you do, again, the deal for me, I'd rather pay the 15 or 20,000 for the QB and have the deal be bad and say no about it than back out too early and ends up being something there, or like forcing myself, and now I'm out even more money. So yeah, it's, that's also where the IC meetings are helpful. Like we'd always use that we went through probably 3 or 4, and it was like, yeah, this is just too much of we missed a few red flags. Let's not even bother with it. But we just found the bare minimum and then try to get exclusivity. And then again, like Rich said, right, you base it on certain factors like SDE, and then you can just go back and negotiate that piece.
Yeah. And it's a great point you made though, Jeremy. Better to make a $15,000 mistake than to make a $3 million mistake. So, spend the money up front for the QOE. Don't try to do a deal on the cheap, because it's going to cost you in the long term.
Someone will give you a discount the second time around.
Yeah, that's true. That's only if you work with us, though.
So I did tie my offer to a multiple specifically. I just don't think the seller even understands that. I don't even think that registered. I think he's literally just like, I did say it's based on this multiple of this whatever that was presented to us. So I can also use that as a, hey, look, but I don't know how far that's actually going to get me. We'll just wait and see.
Hey, sometimes it's broker. I mean, sometimes, right? I mean, everyone's already mentioned it, right? Like the brokers aren't really experienced, so then they've sold the seller on a number, and the sellers agreed to that number. So maybe nothing will change, but at the same time, it means that's going to be with anybody, right?
Yeah.
The next person that comes in at the same asking price or offer price, they're under the same issues you are. If they don't, and they do buy it, well, guess what? Now you know what issues they will run into. They might pop up on the market because they're going to be in trouble. So,
yeah,
I don't know. It's, end of the day, it's always tough. I mean, especially when it comes to like that kind of a carve out, because there's just no clean data.
Yeah, and with carve outs, they have to kind of detail all that stuff out, and it has to be verifiable. Because again, what are you paying for? If you end up, they misallocate expenses, or they allocate too much revenue to the carve out, and then all of a sudden you get it and you realize, well, wait a minute, this thing isn't as profitable, and I just paid X for it. That's the dangerous issue with a carve out, if it's not clearly defined and you know exactly what you're getting in a carve out and what they're taking or what they're keeping. So from that standpoint.
Yeah, and this guy uses it like a friggin' piggy bank too. He just went on a cruise like 3 weeks ago. Business credit card. I got all the statements. He doesn't care. He's just like, give me my business points. I use this to fly back to the warehouse once a friggin' month.
Exactly.
So.
We have any other questions? No, I mean, I stayed on extra for you guys, but that's okay. Because I got a call coming up here shortly. But hey, it's been fun. I know, Dante, we didn't get through all those questions that you listed, but maybe you can have me come back and we'll finish those questions and generate conversation around that. And I'm sure there's a lot to talk about around that stuff too. But I appreciate you having me on, and it's good to see all you guys again. Some of you guys I'll see in Florida in a couple weeks. Others I talk to pretty regularly, so I'm sure I'll see you on a meeting or calendar or a Slack message or whatever. But it's been fun. I enjoy talking about this stuff, as you guys can tell, and I tend to, when I get excited about something, I talk really fast. So sorry about that. But hey, you guys have a happy weekend. And Dante, are you gonna be in Florida?
Maybe. I'm not sure. I don't think so, honestly.
Okay.
I don't think so.
Well, I was gonna say, well, I'll see you there, but otherwise, I'm sure I'll see you on another meeting or another meeting that we'll have. So you guys take it easy. I'm out. Gotta go. Good to meet you. Good to see you guys again. Let me know. And hey, if you guys have any questions, obviously, hit me up through Slack. Don't send me an email, because you guys know, some of you guys know how I am with emails. But if you have a question about anything, ping me on Slack, and I'll be happy to walk you through anything at that point.
Appreciate it, Rich. Take care.
Yep. See you guys.